a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about bond ETFs, a topic which we don't discuss frequently. So this year, 2022, has been a bad year for bonds as well. And bonds are traditionally seen as safe haven assets, but they usually have lower correlations to stocks. But this year, they fell in almost lockstep with stocks, and they failed to provide any safe haven or any diversification benefits to investors. The Bloomberg US Aggregate Bond Index fell almost 12% in 2022. And in fact, this was the first major bear market for bonds in over 4 decades. But many experts now say that bonds could rebound in 2023. And we'll discuss the reasons why they could rebound. But we have also seen a lot of interest in bond ETFs from investors who are selling mutual funds because it was a very bad year for bond mutual funds. And because of the way mutual funds are structured, investors could still see capital gains, and they may have to pay capital gains on their bond mutual fund holdings. So many investors, in order to take advantage of tax loss harvesting, they are dumping their bond mutual funds and buying somewhat similar bond ETFs. And we know that ETFs usually have lower costs. They have much better tax efficiency. So that is why the structure is preferred by investors. And this year in particular, we have seen a lot of outflows out of mutual funds and into ETFs. Now, looking at the reasons why bonds could rebound in 2023, it is because we know that because of the Fed's aggressive rate hiking cycle, the US economy could fall into a recession. So, especially in the first half, the economy will be very weak, and the bond portfolio that could provide some safe haven benefits. Investors usually prefer bonds during a recession. Then, in the later half, if the economy rebounds, then stocks are likely to do better. Then another reason why investors are looking at bonds now is because the yields are at levels which have not been seen since the great financial crisis. So those attractive yields mean that bonds can provide some income alternatives to investors. So that is another reason why they are worth a look. And also, the most aggressive part of the Fed's tightening campaign is over. They have hinted that they will continue raising rates in early 2023 as well, but those hikes would be smaller, not 75 basis points hike that we saw recently. And also, inflation is likely to moderate, particularly early next year. So let's take a look at three bond ETFs, very popular bond ETFs by three different providers. The first one I'm highlighting is by State Street, and this is almost cash-like. So for investors who prefer a lot of safety, not much credit risk, not any credit risk, and not much duration risk, this is a cash-like ETF. The Spider Bloomberg 3 to 12 months T-bills ETF, ticker symbol is BILS, easy to remember. It holds US Treasury bills with maturities between 3 to 12 months. And because of the slow maturity, very low duration, this has very low exposure to interest rate changes, has a current very juicy SEC yield of 4.1%. Quite popular with 326 million in assets, and has an expense ratio of 14 basis points. To learn more about this ETF, you can go to the quote page on Zacks.com. I did a podcast with the provider recently. You can listen to the podcast. You can use the external homepage to go to State Street webpage for the CTF. So 4.1% SEC yield, as I mentioned, and this holds 3 to 12 months US Treasury bills, currently about 27 holdings. The second one that I'm highlighting is if you want to take a little bit more duration risk, go a little further down the yield curve, get a little more income, but still stay in the safety of government bonds, then you can look at the Vanguard short term Treasury ETF. It holds Treasury securities with between 1 to 3 years maturity, so slightly longer duration, but still low duration risk. So higher SEC yield of 4.5%, charges just 4 basis points, ultra cheap, and has almost 18 billion in assets. Again, to learn more, you can use the quote page on Zacks.com to go to the Vanguard web page, and you see the juicy SEC yield there, and you can look at the holdings also, what it holds, but there's not much to see. Those are all treasury securities. The third one that I'm highlighting is if you want to take a little bit more of credit risk too in search for higher income. So we know that corporates in general, the corporate balance sheets are pretty strong. So for investors who have a slightly higher risk tolerance, they can look at short-term investment grade corporate bond ETF. The one which I'm highlighting is by iShares IGSB. This has a 30-day SEC yield currently of 5.2%. This is also ultra cheap. It's a 6 basis points excellence ratio, quite popular, with 23 billion in assets. Again, to learn more, you can go to the quote page, and using the link, you can go to the external homepage, iShares webpage. So 1 to 5 year maturity, corporate bonds, and you can look at the portfolio. In fact, if you want to learn what exactly the SEC yield is, it is described here, a very easy explanation of how this SEC yield is calculated, so that you can compare the yields of various bond ETFs that you are taking a look at. So 30-day SEC yield is interest earned after deducting the fund's expenses during the most recent 30-day period. Now, on the last slide, I have the comparative performance versus the S&P 500 index. So the BILS ETF, which is almost cash-like, that is in the green for the year, up slightly. The other two ETFs that we discussed, because they have slightly higher duration, so they are down between 4 and 5% this year, whereas the S&P 500 index is down almost 19% year to date now. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to our videos so that you do not miss anything. And I'll see you next week.